Hey class, we're now going to go through lecture 29. And what we're going to focus on primarily is how to estimate the change in stock price once you change to the optimal cost of capital. We're then going to finish up with a few kind of changes or alternatives based on how do you deal with the concern that your EBIT might change, and how do you deal with the fact that maybe you have certain preferences for bond ratings, as we'll see below. Now, figuring out the new stock price at first seems actually quite simple. We already estimated for Disney what is the increase in value per share. Or sorry, the increase in value. And so we actually went through three different calculations, as you remember. One was the full valuation method. And we figured out that the value of the firm increased by 39 billion. The alternative was the incremental approach. We estimated the increase in value at 19.6 billion. We're going to use the 19.6 number here, but either one is reasonable. And then we're going to take that total value and we're going to divide it by the total number of shares, which was 1.8 billion. Since these are already in millions here, that's another way of saying just 1,800 million. So 19,623 divided by 1,800 gives us an increase in value per share of $10.90. If we knew that the prior stock price was 67.71, the new stock price is going to be the old plus the new value per share, and we're going to find a new stock price of 78.61. Now this actually seems really straightforward, right? We're just looking for what is the increase in value of the company, divide by the number of shares, add to the old stock price, and figure out the difference. We're making a very specific assumption here. And the assumption that we're making is that the increase in firm value will be spread evenly across stockholders who sell their stock back to the firm, and those do not. And remember, when we do this calculation, what we're implicitly assuming is that we are increasing the amount of debt in Disney, right? So we're taking out a lot more debt, but now we have that money. And with that money, we're going to buy back stock. So what that means is that there are actually two different groups of people, those who are selling their stock back to us and those who are keeping it. And it's not obviously the case that both of those people are going to see the exact same increase in the value of that they make from this new change. Because what it ultimately depends on is how much we offer in the buyback. So this is actually the more general case. We're going to assume a buyback price we're offering. And then based on that buyback price, the first step is to figure out how many shares are we buying back, right? So if the debt increases, the increase in the debt, which is the change in debt at the new, right, minus the old debt. And then we're going to take this and we're going to divide by the share price. This is then going to give us what is, how much we can actually buy, right, per share. To figure out the number of shares left over, right, we're going to take the number of shares before and subtract off, right, the total number of shares we can actually purchase with the increase in debt. So this is how many shares we're purchasing, right? This is everything we had before. And so this is the number of shares left over. We're then going to estimate what is the equity value after the buyback. So we've already argued that the value, the enterprise value specifically, is debt plus equity minus cash. If we rearrange that, we can estimate for equity. Equity is the optimal enterprise value plus cash minus debt. So that'll give us the equity value after the buyback. And the third step is to divide the equity value after the buyback by the post-buyback number of shares. So that means that we're going to take equity value after buyback, divide by the number of shares after the buyback from here, and that gives us the value per share after the buyback that we're giving to people who kept their shares, right? So this, the buyback price, right, which is here, is how much we're offering people who actually sell their shares. Right? This is giving us how much are people making if they keep their shares. So let's try a specific price, the old price. Now, I want to make it clear that you really cannot offer anything below the old price, because the old price is the price that people were already not willing to sell at, right? If you were owning stock at 67.71, that suggests that for the most part, you are not willing to sell at 67.71, right? So you actually generally have to offer a higher price to get people to sell, right? You certainly can't offer them below that because no one is going to sell. They didn't sell when it was 67.71. Why would they sell at 65 or 60? So we need to offer at least the old price, and that's what we're going to do at the bare minimum. So we first estimate the amount of debt issued, right? This is the new debt, this is the old debt. So as we saw, we increased, right, debt by $39 billion. We already saw this in the last lecture. We then estimate that if we are buying back shares at 67.71, this is how many shares we're able to buy, right? It's the total amount of money we now have in debt divided by the price per share. So this is the old number of shares. This minus the new, right, the shares that are purchased in the buyback, leaves us with this many shares left over, right, 1221. We're then going to compute the equity value after the recapitalization. And so we take the optimal enterprise value, which again is based on our prior slides. Right here, right, this is the enterprise value after the recapitalization, because again, we're using the incremental approach. We're then going to add on 3.931, which we got from here, and then the 15,961. So we got the 3,931, right, and then subtracting off the 55,136, which is, right, our new debt. So this is optimal enterprise value, adding on the cash, subtracting off the new amount of debt, and that's how much value we have in equity. If we have this many shares left over, and this is the total equity value, the value per share after the buyback is just going to be equity value divided by this, $83.78. Now, obviously, according to this, it's really valuable for you to keep your shares, right? Because anyone who keeps their shares is going to have a share worth $83.78. Anyone who sells their shares back is only going to have made $67.71, right? So this is kind of this is an instance where no one who participates in the buyback gets any benefit because the price is just the old price. So all the benefits are just going to the people who kept their shares. Another way to say this is that we would expect the actual value per share after the buyback to be somewhere between these. And so as you recall, at 78.61, everyone, regardless whether they sold their shares back or not, equally benefits. Now I can actually prove that. So here's proving that the rational price is 78.61. I'm going to go through the same calculations we just did previously. The number of shares after the buyback is the number of shares we had initially, right, minus the number of shares we purchased in the buyback. This is the amount of dollars we have in debt to go towards the buyback. This is the price we're paying in the buyback. We're left with this many shares. Optimal enterprise value stays the same. Add back cash, subtract off debt, given the equity value. The value per share after the buyback then is going to be the equity value divided by the number of shares left over. We're left with 78.61. So if we offer 78.61 in the original buyback, everyone left over who didn't participate in the buyback gets the same 78.61. So let's answer a few more concerns here. The first is, what if something goes wrong? And what I mean by that is there a concern about downside risk? So maybe our optimal capital calculations are no longer going to be correct if there's a large change in operating income, or if there's a constraint on bond ratings. And I want to go through each of these individually. Now, when we think about operating income, what we're concerned about is that there's a large drop. How likely is that? Well, we actually have a way to answer that, because in a couple of lectures ago, we actually went through what-if analysis, right? We actually considered kind of project uncertainty. So we're going to do something similar here. We can think about kind of what's the standard deviation in past operating income, right? And then we can reduce the base case by one standard deviation or more, right? So if we're looking at kind of a one standard deviation decline in income, right, what actually happens to our optimal debt ratio? An alternative is the economic scenario approach. So we can look at what happened to operating income during the last recession, right? And then we can see, right, if we reduce our current operating income by the same magnitude, what's going to happen to our optimal debt ratio. And then we're going to talk about what happens to our optimal debt ratio if we have certain constraints on bond ratings. If we, or the managers, require, let's say, a AA or a AAA rating. So first, thinking about Disney's operating income. This is information over about a 20-year, 15-year period. And this was the change in EBIT, right? We see very large change in EBITs. For instance, in 2009, right, during the last Great Recession, we saw a decrease of 23%. 2002, we saw a change, right? Sorry, in 2002, we saw a change of 15.82%. 1991, we see a change of 22%. So in the worst year, we had 29.47%. That was the worst drop we had. And that happened in 2000. So that was actually in the tech bubble. A standard deviation in percentage change in EBIT was 19.17%. So if you look at all these numbers, a one standard deviation is 19.17%. So let's consider what happens then if we see different changes in EBIT, right? So if we assume EBIT drops by, let's say, 10%, which is nothing, this is the current EBIT we're left at. And if we estimate all the optimal debt ratios, we're left at 40%. If the EBIT drops by 10%, this is our new EBIT. If we assume this operating income, we still have the same optimal debt ratio, which means that our optimal debt ratio did not change based on a change in EBIT. 20%, we get the same. 30% drop, we get the same. It's only at a 40% drop in EBIT that we change the optimal ratio. And that seems pretty unlikely given that the largest change we saw, largest decrease we saw, was less than 30%, and that a one standard deviation is less than 20. So it actually seems pretty reasonable that our estimate of the optimal debt ratio is actually fairly robust. Now here's a question. Why does our optimal debt ratio depend on this EBIT? The answer is because EBIT is really affecting our synthetic ratings. As you recall, to estimate the synthetic ratings, we need the interest expense and the EBIT. And so if we see a decrease in EBIT, we're actually going to impact the synthetic bond ratings, which is going to impact the hypothetical cost of debt under different debt ratios. And if that happens, then it's possible that our optimal debt ratio is no longer true, right? So if suddenly, let's say the cost of debt increases substantially at 40%, now we're not going to want 40, we're actually going to only want 30. The alternative concern is a constraint on ratings. And really what I mean here is that sometimes management just has a desired rating below which they do not want their numbers to fall. Right? Now, usually the rating constraint is driven by three different factors. One is it's a way to protect against downside risk, which is actually just what we saw when we considered the operating income. Right? So this is kind of an alternative way to protect against operating income. And so the first thing I want to say is you shouldn't do both if that's your goal of doing it here. Alternate, right? And the concern specifically is that a drop in ratings might affect operating income, right? So that's kind of the concern. I think a more reasonable, or not a less reasonable, but a more common argument is an ego factor. It's actually just nice to say that you have a AAA rating or you have a AA rating, right? So you really just want to say you have a really high rating, even if that's not actually optimal to you. And so what I want to make it very clear is that a AAA rating is not optimal in most cases. It might be, but it just as easily could not be, right? Because it depends on this difference between the benefits and the costs of debt. So the cost of a rating constraint is the difference between the unconstrained value and the value of the firm with the constraint. And so if you're, let's say talking to a manager and they say they want a AAA rating, you need to make sure that they're aware of the cost of these constraints that they impose. So let's look again at Disney. At its optimal debt ratio of 40%, Disney has an estimated rating of A. Right? So good, but not great. If instead the managers say, no matter what, we want a AA rating. We're a AA company, we want a AA rating. The optimal debt ratio for Disney is then going to be 30%. And the cost of the ratings constraint is going to be something, but it's going to be, but not especially large. So assuming we require a AA rating, we're going to find out the optimal debt rating can't go below 30%. But we found the optimal in an unconstrained model to be 40%, right? If we don't have a constraint, we had a rating of A, right, with a debt ratio of 40%. So the difference in value is going to be what we estimated the value at before from our calculations, minus the value under the AA value at 30%. So that's going to give us about $6 billion. If the managers insist that they require a AAA rating, we're not going to have an optimal rating any lower than optimal debt ratio any lower than 20%, right? Because if we keep increasing the debt, it's not surprising that the rating's going to drop. So that means that we actually have a pretty tight restriction on our debt ratio. It's not going to be able to go above 20%. 20% gives us a fairly small value, right? Because what we find is that the value at 20%, at 40% was 153. The value at 20 is only 141, right? So we're actually losing now $12 billion in value, according to these calculations. So the point here is not necessarily that AAA, AA is like always a bad thing, but that it's important to realize that it's not always a good thing, right? And that in some cases, we're actually going to want a worse bond rating because it's actually going to give us more value in the long term for the company. The third and final thing I want to point out is to answer, what do you do if you do not buy back stock, right? Because everything that we just did right here is implicitly assuming that you're buying back stock with the increase in debt. You took on a lot more debt. You have all this money in your hand. What are you going to do with it? You're going to use it to buy back stock. So what we're assuming, right, then, is that that's what you're doing with all this money. So what happens to the optimal? Does the optimal debt ratio change if you invested in projects instead of buying back stock? And no, but it's kind of a caveat. No, as long as the projects you financed are in the same business mix as the company has already been in. Yes, if the projects are entirely different types of businesses, or the tax rate is completely different. And that's because, right, our optimal depends on the risk that you're investing in. And if you change that risk level, all of a sudden you're actually changing, right? If you change the project mix, you're changing the risk level, and that's going to change what is the optimal. So it's not necessarily the case that we always need to buy back stock, but if you don't buy back stock, you need to make sure that you're financing kind of similar projects as what you already have. For our class, we're generally going to assume that if you take on more debt, you're going to use it to buy back stock. Alternatively, right, if we think about a scenario where you need to decrease to a lower optimal debt ratio, right, you're actually going to do the opposite there. You're going to pay back your debt with increased stock. All right, so let's do two different questions. First, assume that Lyric Inc., a publicly traded company, has 10 million shares. They trade at $20 per share, and that it has $50 million in debt. You believe the value of Lyric will increase by 10% if it borrows $50 million and buys back stock. Assuming investors are rational, what would you expect to pay per share on the stock buyback? And so the first thing I want to point out, we're assuming investors are rational. That's going to be important for this part of the calculation. In the second part, we're going to now assume you plan to buy back shares at a specific price. How much? $25 per share. And so if you do, what do you expect to happen to the remaining shares in the company? So we have two different cases here. The first is the rational case. And we're going to figure out what is the price on the stock buyback if everyone gets the same value, regardless of whether you're a part of the buyback or you kept your shares. In the second example, we're assuming the buyback happens at $25 a share. So we want to assume what happens to the people who keep their shares. So let's turn to the calculations. The first calculation is actually pretty simple. If investors are rational, that's another way of saying the increase in firm value is going to be spread equally among all people, right? Those who sell the shares, those who don't. And so the increase in value per share is just going to be spread equally among all groups. Right? So we're going to say 25, which was the total increase, divided by 10, which gives 250. Now, where did I get the 25 from? In order to calculate the 25, right, I need to figure out what is the total value of the company. So the total value of the company initially is $50 in debt, right, plus 200 in equity. And I'm getting the 200 because I'm taking 10 million multiplying by $20 a share. So 200 million in equity, 50 million in debt. So 250 in total. Right? If I know that the value of the company is going to increase by 10%, that means the value of the company is going to increase by 25 million, right? 10% of 250. That's how I get this first number. The second number is going to tell us the number of shares currently. And we know that the current number of shares is 10 million. So if that's the case, the increase in total value divided by the total number of shares currently is going to be $2.50. Each person's going to get another $2.50. We're going to add that on the current stock price. The current stock price is 20, so the new stock price is $22.50. Now let's confirm that this is right. We're going to go through the steps where we assume that we are selling or we are buying back shares initially in the buyback at $22.50. So we had 10 million shares. We got $50 million from taking on an additional debt, right? So that's how much money we have left over to buy back shares. We have 50 million divided by 22.5, right, which is the new stock price. And what we're left with is that if that's the case, this is how many shares you're buying. This is how many shares you have left over. We have 7.778 million shares left over. Now let's figure out what is the value of the firm after the buyback. The value of the firm after the buyback is 250, which we said is the new value of the firm, or so the old value of the firm, plus 25, which was the new value that we, right? Because we saw a 10% increase. So now the value of the firm is 275. The value of debt is going to be 100. We got that because we have 50 million initially, and we have another 50 million now. So the value of debt is going to be 100. The value of equity then is going to be 275, subtract off 100, 175 is remaining in equity. If we take the value per share of remaining shares at 175 in equity, right, do we divide by the 7.778 million shares outstanding after the buyback, what we're going to find is that each share is worth $22.50. And so we're confirming what we thought. If we offer $22.50 in the buyback, everyone left also gets $22.50. Now let's try the second example. We're assuming $25 per share is offered in the buyback. We already know something because we know that $25 is better than $22.50, which means the people who are part of the buyback are going to make more, which means the people who don't participate in the buyback are now going to get less than $22.50. So let's see this. The number of shares outstanding is going to be, again, 10 million minus the shares that we purchased, which is $50 that we had in cash to purchase, divided by 25, because this is what we're buying, right, when we buy per share. So we're left with 8 million shares in total. We have 8 million shares rather than 7.778. We have more shares left over, right, because we're paying more for them, and so we can't buy as many. The value of the firm stays the same. Value of debt after the buyback stays the same. Value of equity after the buyback stays the same. So we're only changing then this number. We take the value of equity at 175, divide by the 8 million shares in total, and now we find that everyone who didn't sell their shares are now worth $21.875. So as we said before, if you offer 25, a higher rate, to the people who are part of the buyback, everyone else is going to get a little less money. That concludes lecture 29.